The PE ratio is at 26. It's only been higher than this 3 times in history. In 1929 before the 86% crash, in 2000 before the 49% crash, in 2008 before the 57% crash. History is repeating itself. And there's one thing banks don't want you to know about this number. 3 moves that insiders used to make 300% in the 2008 crash. You can copy them too. This week, let's go. Forget everything you think you know about market highs. This isn't something to celebrate. This is an illusion. PE ratio, price to earnings ratio. It tells you whether the market is expensive or cheap compared to companies' actual earnings. Historical average, 16. Today, 26. 62% higher than normal. Highest in 15 years except twice, 2000 and 2008. Both ended with crashes over 50%. Why is the market so high? Rising earnings? No. Rising GDP? No. Then what? Pure speculation. This isn't a small bubble. This is the great financial illusion. So what do? This isn't the time to panic and sell everything. That's amateur hour. This is the time to position strategically. 3 specific moves so you have cash ready, know what to buy, and buy at the right time. Let me show you. First move, cash allocation. This is your ammunition when prices drop. The problem, most investors are 100% in stocks right now, or holding some random percentage of cash with no logic. When the crash comes, they freeze. No dry powder. How much cash are you holding? 0%? 10%? Or have you never even thought about this question? You need a formula. Here's the formula. Current PE ratio divided by 16 times 20. That's your cash percentage. PE is 26 today. 26 divided by 16 equals 1.625. Times 20 equals 32.5%. You should hold 32.5% cash right now. Why does this work? It's dynamic. When the market is cheap, PE 12, the formula tells you to only hold 15% cash. Most of your money stays invested because stocks are a good deal. When the market is expensive like now, the formula increases your cash position. PE 26, 32.5% cash. PE 35, 43% cash. 2 benefits. 1. You limit downside. Market crashes 40%. You're only 67.5% in stocks. Total portfolio only drops 27%. You saved 13 percentage points. 2. Buying power. That 32.5% cash, when stocks are down 40%, that's your opportunity to buy quality companies at massive discounts. Everyone else is liquidating in panic. You're acquiring assets. If you had 30% cash when Lehman collapsed, you bought the S&P at 800. By 2013, it hit 1,700. That's a 112% return in 5 years, just on the index. Apple or Amazon, 300% plus. Same story, 30% cash in February, bought the March dip at 2,200. By December, 3,750. That's 71% in 9 months. Real example, you've got $50,000 invested, PE is 26, formula says 32.5% cash. You move $16,250 to cash. Stock allocation is now $33,750. Market crashes 40%. Stocks drop to $20,250, but you still have $16,250 cash untouched. Total, $36,500. That's a 27% loss. Compare that to 100% invested. $50,000 drops 40% to $30,000. That's a 40% loss. By holding cash, you saved $6,500. Plus, you've got $16,250 ready to deploy at crash prices. That's the real power. Where to park it? US Treasury bills 4 to 5%, money market funds 5%, high yield savings 4 to 5%. Any of those work? How to implement? 3 steps this week. Step 1. Find the current PE ratio. Go to multpl.com. It's free. Takes 30 seconds. Step 2. Run the calculation. Current PE divided by 16 times 20. That's your target. Step 3. Execute. Below target? Sell some index funds. Move to T-bills or money market. Above target? Deploy some cash. That's move 1. Cash is ready. But buy what? In 2008, some stocks went up 300% right during the crash. Some stocks went bankrupt. The difference? 3 criteria I'll show you in the next 15 seconds. Cash is ready. Now, what do you buy? This is where most people blow it. They buy stocks that look cheap but go bankrupt in the crash. Lehman Brothers in 2008, $60 down to $0.21. Unprepared banks die. You need crash-proof stocks. That's what this protocol finds. 3 criteria. Every stock on your list needs all 3. 1. Strong balance sheet. Debt to equity below 0.5. 2. Essential products. Things people need, not want. 3. Historical resilience. Survived at least 2 past crashes. Explanation. Why these 3? Balance sheet. When the crash hits, credit freezes. Banks stop lending. Companies with too much debt can't survive. Debt to equity below 0.5 means they can operate 2 to 3 years with 0 revenue. Essential products. In a recession, people cut travel, new cars, luxury. They don't cut electricity, food, medicine, utilities, healthcare. Consumer staples stay profitable when the economy tanks. Historical resilience. If a stock survived 2008 and 2020, it's proven. Johnson & Johnson, down only 8% in 2008 when the S&P dropped 37%. That's resilience. 5 examples. Johnson & Johnson, healthcare, debt to equity 0.45, up 6% during the 2008 crisis while the market crashed. Procter & Gamble, consumer staples, 0.42, down only 15% in 2008 versus the S&P down 37%. Duke Energy, utility, people always need power, down 12% in 2008. Costco, essential retail, 0.38, up 9% in the 2020 crash year. Berkshire Hathaway, Warren Buffett's company, diversified, massive cash reserves, survives everything. Warren Buffett isn't doing this for no reason. He's holding $325 billion in cash right now. How to build your list? 3 steps. Step 1. Screen for criteria. Go to any stock screener. Filter debt to equity below 0.5. Filter by sector. Healthcare, consumer staples, utilities. Step 2. Check historical performance. Look at 2008 and 2020. Did the stock drop less than the S&P? Did it recover fast? That's your list. Step 3. Set trigger prices. Current price. Calculate 30% down. That's when you buy. Set alerts. Cash ready. Target list built. Triggers set. But here's the problem. When the crash actually happens, psychology takes over. You freeze. Buy too early or too late. Move 3 solves that. DCA Protocol. A buying system that removes emotion completely. That's next. The crash starts. Market down 10%. Everyone's panicking. You've got cash. Target list. But you freeze. Is this the bottom? Should I wait? What if it drops more? This is why you need a system, not a plan. A system tells you exactly when to buy, how much, no thinking required. Viertiersystem, DCA Protocol. Dollar cost averaging across 4 crash tiers. Split your cash into 4 equal buckets, 25% each. Tier 1. Market drops 10%. You buy with the first bucket. Tier 2. Market drops 20%. Second bucket. Tier 3. 30% drop. Third bucket. Tier 4. 40% drop. Final bucket. That's it. Why 4 tiers? Because you don't know how deep the crash goes. Buy everything at negative 10% and it drops to negative 40%. You're out of cash. Watch the best prices pass by. Wait for negative 40% and it only drops to negative 20%. You never buy. Miss the entire recovery. 4 tiers capture the crash no matter what. Shallow crash, you're in. Deep crash, ammunition all the way down. You can't lose. The COVID crash. Let's run the numbers. S&P 500 peaked February 19th. 3,386. March 11th. Down 12%. Tier 1 triggers. Buy with 25%. March 16th. Down 22%. Tier 2. Another 25%. March 23rd. Down 34%. Tier 3. Another 25%. The crash bottomed at negative 34%. Tier 4 at negative 40% never triggers. You still have 25% cash. That's fine. You deployed 75% at better prices. By December, the S&P hit 3,756. If you averaged in across 3 tiers, you're up 48% in 9 months, while everyone else was frozen in fear. Setup? 4 steps. Do this today. Step 1. Take your total cash. From move 1, divide by 4. Those are your buckets. Step 2. Calculate buy triggers. Current S&P level times 0.9 for Tier 1, 0.8 for Tier 2, 0.7 for Tier 3, 0.6 for Tier 4. Write them down. Step 3. Set price alerts at those levels. In your broker app, Step 4. When the alert hits, execute. Buy equal amounts of each stock on your list. No hesitation. No second guessing. Just execute. 3 moves done. Cash Formula, Target List, DCA Protocol. You now have a complete crash playbook. But the question is, how urgent is this? And what do you do right now? That's what's next. 3 moves done. But the question, how urgent is this? I tracked 4 crash signals. All 4 are red right now. Last time this happened? 2008. Signal 1. Buffett Indicator. Market cap to GDP. Currently 216%. Danger threshold 150%. Red. Signal 2. PE ratio. VINC 6 versus average Cs. Red. Signal 3. Yield curve. Inverted for 15 months straight. Every time this happens, a recession follows within 12 to 18 months. Red. Signal 4. Buffett's cash. $325 billion. Highest ever. What is he waiting for? Red. 4 out of 4. This only appears before every major crisis. This isn't a coincidence. So what do you do right now? 90-day timeline. Month 1. Setup. Week 1. Calculate your cash percentage. PE ratio at multpl.com. 2 minutes. Week 2. Move cash to T-bills or money market. Week 3. Build your target list. Screen stocks. Ain hour. Week 4. Set DCA triggers and alerts. Month 2. Monitor. Check the 4 signals every week. 5 minutes each Sunday. Adjust if PE moves significantly. Month 3. Refine. Finalize DCA tiers based on current levels. Download the checklist. Print it. Keep it by your desk. 2 hours. Total work. 90 days of preparation. Could increase your portfolio 50 to 300% in the next crash. That's the difference between winners and losers. Before we close, 3 fatal mistakes to avoid. Mistake 1. Buying all in when the market is down 10%. Out of ammunition. It drops another 30%. You can only watch. Loss 40%. Mistake 2. Holding 100% cash, waiting for the perfect bottom. The bottom hits at negative 34%. You wait for negative 50%. It recovers. You miss everything. Loss 100% of the upside. Mistake 3. Panic selling quality stocks at the bottom to cut losses. Sell J and J at $110 during the panic. 6 months later, it's at $160. Loss 45% potential gain. My 3 moves avoid all 3 of these mistakes. That's why they work. That's why insiders used them to make 300% in 2008, while others lost 50%. Here's what you do right now, this week, not someday. Market crashes don't send a calendar invite. They happen fast. 2008, 2020. No warning. You just wake up one day and it's too late to prepare. The difference between investors who profit and investors who panic. It's preparation. 3 moves. Complete system. Move 1. Cash allocation. 32.5% if PE is 26. Your ammunition. Move 2. Target list. 3 criteria. Set triggers at negative 30%. Move 3. DCA Protocol. 4 tiers. No emotion. Just execute. I've created a 1-page crash profit checklist. The formula, sample target list, DCA calculator, everything you need. First link in the description. Completely free. Download it now. Print it out. Stick it on your desk. Because when the crash starts, you won't have time to think. And a controversial question. PE is at 26. Do you think the crash will come in 6 months, 12 months, or 18 months? Comment your prediction. Whoever gets closest, I'll highlight in next week's video. If this video helped you, share it with a friend who's worried about the crash. They'll thank you later. Hit like. Subscribe for crash-proof strategies. Comment your timeline prediction. Remember the question at the start, the team that loses 40% or the team that makes 300%? Now you know the answer. These 3 moves are your ticket to Team 300%. Market record highs. PE elevated. The crash is coming. Be ready.